Hello, good morning or good afternoon, depending on where you're logging in from, or even good evening if you're logging in from Asia. Welcome to our webinar. It's Tuesday, the 2nd of June, and we're coming to you live from the UK and from the US for our US-focused webinar this afternoon. So this is part of a wider series, the Solar and Storage Finance Digital Series, which is running all week this week. So yesterday we looked at Asia Pacific and we kind of caught up with some of the tenders which are sort of happening in different markets like Myanmar and Malaysia. This morning we looked at Europe and we looked at the kind of part that solar might play in the post-COVID recovery. We looked at some of the plans for this green economic New Deal, and those videos are all available on replay. To get more information about the replay, the sites that you need to visit is digital.finance.solarenergyevents.com. Now, of course, the series wouldn't be running without the kind support of our sponsor, Trina Solar. So I'd like to to give them a very big thank you for their support this week. So do check out their kind of session, which happened this morning, and that's Vertex by Trina Solar. You'll also be able to network with the guys at Trina and all of the other speakers and delegates throughout the week. That's in our dedicated networking zone, and I'll drop a link for that into the chat box once we get going on the webinar. Lastly, from my side, you should see on the right-hand side of your screen, there's a panel where you can throw questions at the speakers. To put them in the questions tab. If you have any questions to the Solar Media staff, then drop them in the chat box and I'll be here throughout the webinar answering those. Do keep those questions coming, which we'll answer at the end of the session. Last but not least, Solar Media is, of course, an events and a publishing company with the publisher of PV Tech, Energy Storage News, Solar Power Portal, and Current News. So do check out our full portfolio on solarmedia.co.uk. So without further ado, I would like to hand over to our panelists for this morning. So Shariff joins us from Nixon Peabody, and he will be your chair. So Shariff, I'm going to hand over the mic to you and take myself gracefully off stage. Thank you.
Thanks so much, and welcome everybody. Good morning, afternoon, and evening. I'm Shariff Barakat. I'm a partner at Nixon Peabody in the Washington, D.C. office. Nixon Peabody is a national U.S. law firm, full service, and we have a focus on renewable energy. I focus on tax equity in particular, but we really do the full spectrum here with respect to these projects and the transactions. I'll pass it on, Joe, if you could introduce yourself as well.
Sure, thanks, Shariff. I'm Joe Ritter. I'm with Seminole Financial Services. Seminole is a national boutique lender. Also do a small amount of tax equity, to a much smaller extent. Our focus again is all of the United States, and product types from C&I, distributed generation, community solar, small utility, basically 1 megawatt up to 25 to 30 megawatts. And to date, since 08-09, I think we've deployed in excess of pretty close to $2 billion in capital for projects.
Thanks. And Peter, could you introduce yourself?
Yeah, absolutely. Thank you, Chief. It's great to meet you, and it's good to see everyone else dialing in. My name is Peter Coleman. I'm an SVP of Treasury Finance at Standard Solar. Standard Solar has been around for about 15 years, previously founded as an EPC company, and more recently has turned to more of an all-inclusive IPP, independent power producer, focused on C&I and distributed generation in the U.S., including solar and storage. We currently own and operate about 115 megawatts across 13 states and have a pipeline up to about 300 megawatts currently planned to be constructed in the next 12 to 24 months.
Thanks, Peter. And finally, Rich, if you could please introduce yourself and your company.
Sure. This is Rich DeVere. I'm a co-founder and managing member of C2 Energy Capital. C2 is a developer and owner and operator of DG projects across the U.S. We operate a little bit over 140 megawatts of assets now and are under construction for another 175. And we're based out of New York.
Thanks, Rich. Well, let's get kicked off here. And please, as you heard, throw some questions into the chat box. We would love for this to be a dialogue and take this where you, the listeners, want it to go. But let's kick off here with probably the question that's on everybody's mind. What's going on right now? What's the state of play? A lot of things are changing in the world generally, but what's changing in the solar world for each of you guys? Why don't I just kick it off here, Joe? Why don't you start us off?
Sure. So what we're seeing, there's not really been a slowdown in terms of projects that we're evaluating for financing, mainly debt financing. So I guess I'll kind of speak put my debt hat on for a moment. Plenty of projects out there, looking to get started. I think the biggest void right now is in the tax equity space. So for us, as a construction lender, we're asked to bridge tax equity. So without tax equity being there, it's kind of hard to do that. So putting my tax equity hat on for a moment, we had pre-COVID had a $40 million mandate from a regional bank to place some tax equity on their behalf. Post-COVID is, hey, we're gonna hit the pause button and reassess, and let's talk again in Q3 once we kind of figure out where we are. So, again, evaluating a lot of projects needing debt financing and really tax equity financing. So it seems like the market is strong. We just got to get find a solution to get these projects across the starting line.
Yeah, I guess, Peter, from that more IPP perspective, we just heard from the financing party, how's it translating for you and actually getting, moving those projects along? How do you do that now?
I agree with Joe. I do not think there is a shortage of projects that are going to slow down. I think the closest thing to all of our mind currently, as Joe alluded to, is our industry is driven by tax equity. That's how we subsidize or at least offset some of the cost of projects. Is it going to be there? Last time we experienced the current situation was in 2008, 2009, and the government had to resort back to 1603 in the cash grant. Will that happen? I don't know. There's a lot of lobbying going on right now to potentially push us back in that direction, but we can't bank on that currently. So the fundamental question that all of us are asking ourselves, and getting a similar message to what Joe just said, is that a lot of tax investors are not shut down for business, but pressing pause for a period of time to evaluate the situation until, like better, kind of the dust settles. And there is a fair amount of uncertainty in that market that has to be considered by all parties in the development and investment process.
Great. Yeah, I saw an article this morning actually from Bloomberg News saying it's going to be the third largest solar year yet, right? Still, notwithstanding all these, the rumblings we hear in the market that you guys just conveyed, that there's pauses going on and the project's aplenty still. Do you guys agree with that? Rich, how about yourself? I'm sorry, go ahead, Peter.
No, I mean, look, I think that, sorry, Peter, go ahead.
Go ahead, Richard, you're good.
I mean, I think that, look, the pause, we're not that far away from Q3, right? So, I mean, I think that that's the other thing. It's impossible these days to take, to do long-term planning relative to this year. And so I think that, and there are just so many unknowns. So I think that really what this situation alludes to is the fact that when you have, if you have an incentive structure and a market structure that is built on something that is hypothetically so volatile, which is the fact that, are there going to be people in the U.S. market that qualify, that decide that they want to make an investment in this? That is the only way that solar gets built, or that's the only way that wind gets built. And I think that in and of itself is sort of speaking to the overall issue. And rather than the fact that whether or not this year, being a bigger solar year or smaller solar year, I mean, I think that ultimately there will be what you're seeing with that, third biggest solar year is there were a lot of projects that were delayed 2 years ago because of tariffs and component availability. Those commitments were already done. People are executing on those commitments. That is really what people are I think, speaking towards when they're talking about the amount of megawatts that are going to be going into the ground. I think that this will have an impact that is going to be more salient in about 2 to 3 quarters, when you'll see that the pipeline of projects just had not gotten started because there wasn't adequate enough tax equity to get people on the financing side comfortable. But large corporations are going to pay taxes, right? There is no way that that's not going to happen. So the question is, when is that going to be when is the market going to stabilize and feel that it is an appropriate time to start making those investments? And I just, honestly, I think that, if you're, while you want to necessarily be a tax equity, you want to try and, lobby for tax equity coming into the world. I think that if you're, a reasonably minded participant, you're probably, taking a beat for a second before you make an investment in anything, right? At this point, just because it is such an uncertain time in so many ways.
Thanks, Rich. So, I think what I'm hearing from Joe, from you, Rich, generally is that we're talking about a pause, right? That's the expectation here. The tax equity, the tax appetite's going to come back. There's a lot of uncertainty. And I think what we're talking about then is really the construction and the development projects, right? Those ones are the ones that are on pause, that we're seeing. And just so the viewers understand, in the US market at least, because tax equity is such a critical component of the long-term capital stack, often it's very hard to build a project without that commitment very early in the construction cycle. And so, one of the things that we just heard is the response that was in 2008, 2009, the US Treasury started cutting checks to folks instead of running these subsidies through the tax code. And that was in response to the fact that the banks, the biggest suppliers of tax equity, are generally, they weren't taxable during that time. That's not the case here. And I know you guys alluded to a number of the potential, the fact that there's talk right now in Congress and the US Congress policy changes. What do you guys think would be most impactful? What could really solve this situation?
So, I mean, I think that we're not changing the fact that the major incentive is going to be tax driven, right? That's ultimately how the U.S. decides that it pushes policy initiatives. So I think that you have to look at the question and say, okay, well, what can you do to increase the size of that potential base of investors and bring more people into the mix? So, I think there's sort of a lazy default strategy to say, okay, well, let's have the government just write us a check and these direct pay components and trying to just get the government to basically do the work for you. I just don't think has the political viability at this point for renewables or just pretty much for anything in the U.S. these days. So, I mean, there is, but in terms of the nuances for tax equity, there is right now, unfortunately, a very small subset of taxpayers who are eligible to participate, and I think that to the extent that you can widen that group, that's really what makes a difference. And so there's a provision of the tax code which was part of the 1986 amendment, which basically limited the ability for most individuals to benefit from these types of tax shelters. And I think that especially when you're looking at what is happening to an individual taxpayer's, the economic impact on an individual taxpayer, I think that the ability to suspend, it's called Section 469, suspend the passive activity loss rules, would put you in a position that instead of it just being a few corporations and insurance companies that are tax equity investors, you could basically make the entire tax base of the United States an eligible investor in these projects, which really would, I think, materially lower the cost of capital and also still, by virtue of that, create an opportunity for the large tax equity investors who have experience and balance sheets to bring retail investors into the fold.
I think Rich
Yeah,
hit
sort
the
of a-
nail on the head there, Sharif. I was going to say, suggest the same thing, that, relaxing the restrictions around active passive loss rules and things like that would be huge for the industry. And I think leveling the playing field, for ITC compared to some other credits and some accounting benefits that other tax credits receive would certainly go a long way as well. I would love, just, hey, I recognize, Rich. It certainly is the lazy way, but as Peter mentioned in his opening or in the opening question, having a cash grant, I think the floodgates would open up. But to Rich's point, politically, the support isn't there right now. Fortunately, we're in an election year. We'll see what happens come November and possibly then in January if there are some changes made and kind of reassess that. I think probably in 2021.
But Joe, so in your construction lending business, which is the core of your business, how would you feel? I think one of the things that we're seeing now that we have the benefit of history to look at with 1603 is the uncertainty of the payment of the payout of the grants, right? So people would make applications whether they were too much or fraudulent or not qualified, whatever it might be. If you're a construction lender and your typical business model is to say, okay, I want to lend against tax equity commitment, and in this case, the government takes the role of the tax equity investor, how would you think about the risk and how could you, I mean, obviously we're talking about a hypothetical of a hypothetical here, right? But just hypothetically, doesn't it make you nervous, the fact that to a certain extent you're relying on a program that when this cash grant was created in 2008, there wasn't, I mean, I remember doing deals there was never a question about you were going to get whatever 30% was, right? I mean, it was not, but it doesn't necessarily seem that would be the case. And probably the government would also have the benefit of history there that the payout mechanisms would probably be scrutinized so much more heavily and with so much more time. How could you feel comfortable? I mean, do you actually think that a cash grant program could help you get more comfortable as a lender? Yes, it's more money coming in, but how does it? It basically would, I think, require a lot of more equity to build the product.
Sure. No, that's a good question. I mean, certainly there's political risk around, I mean, even the tax credit and things like that, especially with, kind of current administration's view on renewables, right? And, but looking at going back to, post ARA and 1603, none of the, I mean, just looking at our history, none of the developers, none of the projects that we, where we relied on the 1603, none of them faltered. Now, to your point, it went from, submitting your questions to the submitting your answers, to the Treasury and getting paid out within, 30 days, getting a check within 30 days to, okay, then there was a second set of questions, right? On day 29 that you received, you responded. Now there was another 30 days where you had to wait for your check. And so there was sort of a protracted payment timeline as 1603 started to phase out and whatnot. But, I guess we just didn't have any experience with anybody not being paid out or fraud. I know that there was certainly some nefarious, unscrupulous folks out there that, when you're giving out free money, they're the, one of the first to line up and put their hand out. But fortunately for us, we didn't encounter any of that. So, it remains, like you said, it's a hypothetical. The hypothetical would remain to be seen, kind of how the program is structured and what kind of comfort that we could get around whatever that program would look like in the future.
I think
that's an interesting. Go ahead, Peter.
I was going to say the biggest point, Richard and Joe, you talked about is just getting the parties aligned. I think the renewable energy industry is not very well aligned and coordinated in the lobbying effort. And in order to put anything like a 1603 cash grant in place requires very close alignment among all the parties, the leaders in this industry. And we need to get better at that. And I'll just be totally honest. I think that, we are a fragmented industry that in some cases fight each other rather than get aligned in what's in the best interest for our total industry. So I think, getting a 60 cash grant in place anytime in the near future would be hard unless the leaders in this industry get aligned and lobby coherently to the U.S. government.
And it sounds like what I heard there, Rich, as it may be notorious, tax equity is a bit of a headache in the U.S. We're running these subsidies through the tax code. But the cash grant program had its own hiccups, right? We talked about the delays and the scrutiny. So it sounds like each one of them has some pros and cons. It's not kind of a slam dunk for all of our panelists here that you just go straight to the cash grant program with knowing kind of how it went down last time. But let's look at some of our questions, because we got a few questions trickling in here now, and kind of on this related topic about policy and actions from the central government here. There's a question about the fact that solar and renewables generally were not provided any stimulus in the recent federal stimulus packages. How much is that hurting the industry? What could have been done? We're hearing some ideas here, open up the investor base. Those are very structural type, fundamental to the subsidies. But responding to this question, how far back have these been set by not getting help kind of timely?
I think in stimulus, I think it was stimulus 3, right? It was the stimulus 3 that got held up on account of some push pull, and I think the Dems were trying to push through ITC extension and things like that. From a personal standpoint, I think it was the wrong time to sort of lobby for something like that when we were trying to get stimulus checks out to folks that needed to pay rent or pay their mortgage or buy groceries and that type of thing. I think it definitely is something that needs to be done. I don't know whether it'll happen. I don't think it'll happen in whatever the next stimulus package is. Obviously the House had already passed what they did, and I don't think there was much in there. So certainly don't expect anything to come out of the Senate from there. I think it's a long view. I think what's going to end up happening is kind of kicking the can to November and seeing what happens then, and then hoping for, if you're a proponent and an advocate for stimulus, if you will, of the renewable sector, hoping that you're able to square that circle come November.
We have another question here. The recent ITC extension until October 15th, I think this is referring to the Treasury guidance that came out recently with some kind of very specific rule tweaks, extending the continuity safe harbor for those of you who know how begun construction works to qualify these projects in the U.S., and then also tweaking an accounting rule. I know we previewed this, and I think the questions being framed up here just more generally, could tweaks like this, did this tweak in particular move the needle? Are you guys, let's start with you, Peter. Did this tweak, is there a tweak that could come from Treasury, maybe not from Congress, that did or could move the needle?
In our case, it does not factor into our safe harboring strategy. Generally we lean pretty heavily on the 5% spend requirement. Rarely will we push for the continuous of construction. So I think the general view is that it did not impact or change our strategy moving forward. It's a nice to have. There may be opportunities in the future where we can leverage it more. But based on what we have thus far, it has not impacted our overall, growth opportunity.
Another question we have here, I think what we've been talking a lot about so far, we talked about the policy, what's going on with the construction and development projects. Before we kind of move off that, we have a question here about storage and just kind of How is storage fitting into that mix? Are any of the recent events impacting what you guys are seeing in terms of maybe the economics or the incentives of your customers and the projects you have to move to storage? What's the update here with respect to storage in particular? Why don't we start with you, Rich?
I don't think there's that
Go
much
ahead.
material update. I mean, I think that, you wonder whether in a post-COVID world, people would look at, resiliency as part of the value proposition, but ultimately, I think storage, there's nothing disproportionately impacting storage versus solar, at this time. I think it's just a matter of continuing to seek the right opportunities for the application. And we continue to build and develop, our portfolio of storage projects. But it's not, it really is just a matter of finding the right application and how we can, how that can be leveraged.
Right. I agree. For better or worse, we live in a regulated market, and we're bound by the rules of the different states and the PUCs in each state, or PSC. So we do have storage projects in states like Massachusetts or New York that have programs in place that incentivize and make it a accretive acquisition or investment. But on a standalone battery basis in a merchant market, I don't think it's a position we're currently in a position to take, and very few are, especially given the current turbulence and condition of the capital markets.
And Joe, how about yourself in that construction lending business that you guys have? Also, the other side, the other arms, the financing business. Are you seeing any trends with regard to storage that are worth highlighting here? I mean, maybe COVID or non-COVID related, just broadly.
No, the only trend I see is that we keep talking about it. We keep talking about storage, right? I mean, it's been several years now that we've been talking about storage, and I think we're getting closer. I think with some recent, is it Massachusetts looking to retool the SMART program to more heavily incentivize storage. I certainly think that we'll see more. We've financed some storage, but it's all been coupled with PV. No standalone. Not saying we wouldn't, but it's a tough proposition absent contracted cash flow, for us to finance, quite frankly.
Great. And so, we've been talking about the pause and the impacts on the construction development projects, and we haven't really touched on the M&A market aspects of this as much. And how is this changing investor and aggregator and owner IPP appetite for projects? It's very rare in the U.S., just for the audience in case it's not known, for a project to kind of go from A to Z with the same developer. They often change hands. There's a robust M&A market here for both construction development as well as operational assets. So, Rich, why don't we start with you? How is the latest impacts in the world impacted your M&A outlook?
Yeah, I mean, I think that for us, just because of the impact ultimately on the team, and the fact that there is ultimately an operational and a cultural impact to moving out of the office and not being able to work together as much as we do physically. And just the inherent stress of the world right now, we've decided to focus our M&A really on existing relationships or strategic partnerships that are being created, at least for the time being, because it's just at this point to push our team disproportionately, to chase projects is a hard task. So we're really trying to allocate our bandwidth very, very carefully, and we continue to see a lot of M&A opportunities. It's just a matter of what we think is the right thing for us to spend time on at this point.
And just following up on that, it's historically, you hear the talk of town is that this has been a seller's market for quite a while. Is that changing at all, Peter? Are you seeing any of that dynamic shift?
I don't think it's changing yet, but I can't tell you if it's going to change. Richard's comment was a good one. I mean, things are changing from a buyer's perspective. Capital unquestionably is more expensive, tax equity and debt. There is less capital in the market, but I do not think it has necessarily trickled down to actually the development or M&A level yet. People still see solar as a non-correlated stable cash flow that is a relatively safe investment relative to other type of deployment of capital. So I do not think it has, from my experience in the M&A market, impacted the market yet, but I think it will in the next 3 to 6 months, because there are certain investors that don't necessarily control their own balance sheet, their own capital, and they will be hurt by the current situation naturally. A private equity firm that has high return hurdles will commonly hold back some degree of their capital when it's not already committed.
And I think there's probably also a difference. It's not, there's the M&A market for operating assets, there's an M&A market for NTP assets, and there's an M&A market for development assets, and M&A market for assets that have tax equity commitments, right? I mean, I think that, that all of those things are very, very different. And so, as we look at it, as we look at the, we haven't seen any negative impact on our operating portfolio, right? I mean, at this point, a good chunk of our portfolio is on Walmart's, and that's not a business that's been adversely affected by COVID ultimately. So, for things that are under construction, definitely construction delays, but things that are under construction that we have tax equity commitments for, it's pushed a little bit, but not necessarily a negative impact. And there's still a material amount of investor interest, even in our case, unsolicited investor interest in acquisitions for operating assets.
And I think from our perspective, as Shariff, we haven't been impacted by, some of the projects that we finance, we provide construction financing for, we lend against a takeout, right? So Rich or Peter or the developer is going to sell that project to a buyer. So nothing that we have financed have we been immediately impacted by, but there are some things in our pipeline, things that we're projects that we're currently underwriting, construction financing that we're currently underwriting, where I think to Rich's point, there's a lot of different types of M&A, and I think there's obviously also a different types of buyers, tax efficient buyers versus ones that aren't and have to go out and source outside third party tax equity. And for those projects, the latter, or those types of buyers, the latter type of buyer, they're non-tax efficient buyers. We've seen a pause. Again, kind of going back to your, the opening question here, just the uncertainty around tax equity has caused that buyer to slow down a little bit. And I don't have insight into whether term sheets were pulled, or maybe they just weren't at the point. They had worked with an investor, and they just couldn't get to a term sheet now, and they have to kind of reassess their position. But it started, and to Peter's point, I think it will. I think we will see. I think it'll be a little delayed here in the M&A world. We'll start to see some more, I think, of this slowdown in the months to come.
And I would say, I think that was Richard. I was going to say, in regards to a point that you made, Joe, I have yet to hear of a tax equity or a lender not honor a term sheet. So I think that's a huge hurdle to get past. Once you get there, I don't think they'll walk away, or at least I haven't heard of one doing it. Doesn't mean it's not going to happen, but that is a very important point that I think we need to lean heavily on, is that once you get that, it's a degree of confidence that we can all move forward with projects through construction and financing once a term sheet's in place. So that continues to be a very important goal of ours as we look to finance our portfolio for the next 12 to 14 months.
I had to your point, Peter, I had a phone call with a developer yesterday that's looking to us for construction financing, and he made a comment that he'd received terms from a tax equity syndicator. Now I don't know who it was, and I don't know if it was a term sheet or just terms. And he he was dismayed by the terms he received and said, we're disheartened here. We thought we'd see more. This is a little rich for us. And my comment back to him was, if you've got terms from someone, a bird in the hand's worth two in the bush at this point. Kind of take it and run with it. I don't think now is the time to play the market and go to the next dealership and see if you can get a better deal on that car.
Yeah, no, I understand and agree with your point.
Well, but I actually, I think that I cut out for the last 30 seconds. I think that in terms of waiting, I think, Joe, you were saying that, was that a debt term sheet or a tax equity term sheet, the connection?
It was a developer that we're looking to provide construction debt on, who was upset a little bit by the terms they received from a tax equity syndicator. They thought it was a little richer than they had anticipated. And my comment was, I would, now I don't know what the terms are, but if you have something's better than nothing. And when you're facing construction deadlines and off-takers who want to see the project now, and it's already traded hands a couple of times and that type of thing, you may want to just take what you have and put it on, put it on your resume and move on to the next. But
yeah, I think it's a matter of, I think the key point there is deadlines. To the extent that you don't have the appropriate level of flexibility that would be afforded in the PPA, or for that matter, construction schedule generally, or for that matter, with whatever delays you might be able to take, relative to COVID. We've gotten a couple of term sheets, from folks that, again, we are bullish on the fact that the market is going to come back to normal, right? Because ultimately, to the extent that you're, if you're not, then if you think that this is the best that tax equity is going to be for a very long time, and the terms are disproportionate, then it's probably, your business model has probably much greater fundamental issues, and that will ultimately continue to separate the larger institutional players from a smaller player, if they feel like the best tax equity they're going to be able to raise is at a cost of capital that's 20 or 30% higher than what it was. But and I think that represents a much more fundamental issue. But if you are if you have a little bit more flexibility, I agree with Joe. If you have deadlines, you got to do what you need to do relative to deadline. But you don't necessarily need to take the bad deal. We had one investor who, new investor, they wanted to talk to us. They announced the deal onto the market with a smaller group, and then everybody started calling them. And between the 5 days that everybody started calling them, they said, okay, well, basically our cost of capital has gone up by 35% from what was anticipated. Okay, great. I know that you're the belle of the ball right now. That's fine, but presumably the people that are willing to pay you that incremental 35% of your cost of capital probably aren't the right sponsors, right? They probably don't have the level of financial stability or track record, or capability of otherwise raising tax equity. If that's what you want to do, then that's what you want to do. But if you have, just because you're, just because you're the belle of the ball right now does not necessarily mean that the market mechanisms will not catch up. And then, you're just basically going to be left with, a lot of shattered expectations of what you might be able to get as a return on a go-forward basis. And we saw that a lot. The solar industry has gone through this over and over again. We saw a lot of people raise capital predicated on terms that they thought that were going to be more aggressive. The cost of capital for the market went down, and then they were sort of stuck there with not really an ability to transact. To the extent that you have the flexibility of a little bit more time, which I think the larger groups do from an overhead standpoint and from an asset standpoint, the ability to keep construction moving, you should take advantage of that. To the extent that you have a construction deadline, then 100% bird in the hand. But the syndicator role in tax equity when taking advantage of the moment, I think is going to be, I think is a rough deal. And I don't think it's necessarily something that is not a deal you have to make right now, because tax equity will come back, and things will recover.
Yeah, I understand what you're saying, Richard. I think the problem with this tax equity market is that it is 10 to 15 players in it, of which 50% of the market is controlled by two. And the others that capture the 50%, there is a mix of a lot of syndication going in there. So it's not necessarily the investor who's taking the position, they're leaning on someone else. And that's money they don't control. So the question is, will that syndication partner be there, and what their cost of capital will be? We don't know the answer to that.
But if to the extent that that's the case, and you're using that as a predicate for which there should be, that it justifies sort of paying a higher cost of capital for tax equity, it probably makes sense at that point to exit your project to somebody who has more direct access to the top tier. Right? Because when you think about it from accelerating your cash flow standpoint, it's probably much more cost effective for you to monetize the project up front to a group that can get to, a direct primary source of tax equity. And to the extent that that is the case, then I think it's worth probably a cost benefit analysis, which I think has been the industry as a whole has been a little bit late to getting back to, right? Because there was so much tax equity available, you started to see smaller shops that were not built to be IPPs, that did not set out to be IPPs. They were just developers, and then somebody said, well, why don't you keep your projects? And that worked at a time where there was more tax equity. So now there's less tax equity, and you see the fallacy of that business model, and why, if you don't have an ability to operate a portfolio that can weather these types of storms, you were never an IPP. You were just a couple of guys who got lucky to find somebody to give you some tax equity, right? It doesn't make sense to run a platform, especially in DG, that operates anything less than, I'd say, 200 megawatts, right? The overhead cost of doing that just doesn't make sense. And if you're a group and you've done a tax equity, you've got 20 or 30, 40 megawatts that you're operating, and that's your business plan, and now those business plans have changed, you're probably in a position where I would be reevaluating the business model, not complaining about whether or not there's enough tax equity available.
Yeah, these are a lot of really good points here. Just kind of talking about, as everybody hears the theme, tax equity, the constraining factor. Kind of taking it back to you, Joe. You have a view into a lot of businesses, right, as a construction lender. And I'm curious, we're hearing Rich just mentioned the C&I market, right? It's a kind of a size that he thinks makes sense there. What types of segments would you say are going to be the hardest for you to underwrite going forward? Rich talks about the easy access to tax equity. Who's probably going to be the hardest hit here, and who's going to be the most unscathed?
I think there's going to be a tightening of looking at, we first and foremost, at Seminole, we take a more of a common sense approach when looking at off-taker credit, right? So we haven't drawn a line in the sand to say off-takers have to be investment grade. We're willing to listen to the conversation, evaluate, kind of assign a shadow rating, if you will, or just kind of make it, like I said, a common sense sort of a judgment call on offtake. I think looking at what has happened here, do we expect that the country will shut down again in the future? Hopefully not. But I think largely, between us as a lender and others out there, I think there's going to be a tightening around off-taker credit and willingness to finance those projects, or spreads will be adjusted, or whatever the case may be. Now, the counterpoint to that, and I've always said this, is community solar, right? So we love community solar. We love the portfolio theory, involving community solar. So if the example that I've used before, if somebody comes up to me and says, hey, I've got, the the last standing Kmart in the world and they want to put solar on their roof with a 20-year PPA, my answer is, hey, Seminole's probably not the lender from a long-term perspective, not the lender for that. But if you came to me and you say, I've got a 1 or 2 megawatt community solar project and I've got Kmart down the road that's going to take 5%, so long as it's a plug and play market, you have a lot more flexibility when it comes to the credit profile of subscribers than you do the credit profile of single offtake, single offtake PPA offtakers. So I think, Shariff, I think that's probably looking into the future, from a lender standpoint, where I think things are going to tighten up a little bit, is just being a little more scrutinizing the credit of the off-taker just a little bit more.
That's really interesting. It almost sounds like it could be this could lead to more interest in community solar because you have that diversification, that portfolio theory. So we have a question here that popped up, I think, Rich, based on one of the comments you had made regarding, whether the fly-by-night shops, so to speak, should be out there getting their own tax equity, or if they should kind of sell into a more efficient, full capital stack type player who can bring that all to the table. And one of the things I thought of, implicit in what you were saying, is that full cap stack player isn't going to take advantage of it, pricing wise, just like the tax equity syndicator, 35% higher. So, but putting that aside, the pricing, what are the advantages, disadvantages is the question to trying to do it yourself. We've probably heard a lot about raising tax equity, but what else kind of are the key distinctions between just giving it up and trying to finance it yourself?
I mean, I think it's just a matter of what your business is, right? I mean, I think that a lot of people, again, I've seen this over, the last, particularly post ITC extension. There was a big push for a lot more tax equity. Folks like Joe and the syndication group and other syndicators bringing in new tax equity investors, other larger investors, making larger commitments. I think that that has enabled people ultimately to retain ownership in projects. By the way, including us, right? I mean, the only difference that I think we are in, right? We are, I founded the company with my partner on a kitchen table, right? We had no outside capital. I mean, we just caught a moment with a couple of really good projects, and that's where we were able to establish ourselves. But I think that our intent was to be an owner of assets, so we didn't really have material development operations which are capital intensive. So we were looking at this and saying, okay, we're going to be an M&A shop, we're going to buy assets, finance them, and own them, which meant that we didn't have a lot of capital that was tied up in the liquid investments that we could not otherwise realize. For a developer that's saying, okay, we're going to be a developer, owner, and operator, you then are saying, okay, well, I'm going to have a bunch of capital tied up in development assets, and I'm going to have a bunch of equity tied up in projects, such that when there's a cash crunch that comes along, you end up finding yourself in a position where you need to find money somewhere. And that makes it a lot more difficult. So you can have a dual business track, and you can have the development and the operation combined, but you need to have liquidity in order to be able to do that. And if you don't have, if you're a startup, let alone any startup in any industry, that's hard, right? Finding that liquidity is hard. So I think that the need to the thinking about raising tax equity on your own is really, I think, just you can just, I think it's an MPV calculation. You can say, okay, well, if I own this asset, what am I taking in terms of execution risk, long-term operation risk, long-term payment risk, all the insurance risk, all these other things, and factor that into a financial model, discount back that amount, and then say, okay, well, if I were to sell, would I get this amount or in excess of, right? That I think right there is not, it's not the whole story, but I think that if 90% of the development market were to make that assessment, they would probably see that while the gross numbers over 20 years are larger than what you would get, the time value of money, and especially the value of money in this time, really would make a difference in order to be able to monetize it.
So very much a math equation for you, very finance driven. That's the majority of the analysis.
It's money, right? I mean, like it's not that actually, I think, is that question in and of itself is part of the issue. People get emotionally attached to a solar asset, right? And that's exactly the thing, right? And I've seen it before. People really, they took a risk and they did a good job and they brought a project forward, and it's very difficult for them to let go of the asset for what they feel is value that would not otherwise be attained, or that they could retain it. And I get that. Trust me, I get it. I can appreciate that. I totally, I would say in certain instances, I'm definitely guilty of it myself. But we've retained ownership of the assets. But if it's your personal money, which is basically what it was when we got started, maybe you can make different decisions around that. But if you are actually representing investor money, whether it's institutional or friends and family, you have to make the right investment decision. You have to make the right quantitative decision. And I think that if you don't provide a level of financial analysis to doing that, then basically you're not fulfilling your responsibility to your investors.
Yeah, I mean, I think the simple answer to Doug's question, Doug Johnson, is the buyer proven? Have they been in this industry a long time? Do they know what they're doing? And who's the money behind them? And if you are selling to a large company that's been around a long time and has done C&I investment or solar utility scale investment and is backed by whether the direct company or the parent of that company is a utility, that as long as there's no financial contingency in the agreement, you're as safe as can be. Who cares about who bears that tax equity risk? That's their problem. So, Doug, you should look at who your buyer is and what contingencies they have built into the agreement. And as long as you can have the right to be paid for a project that you successfully deliver, you shouldn't worry about whether the tax equity is in-house or out-of-house.
And Peter, for those of you who don't know, is owned by a utility. But no, I mean, look, it's also a matter of the strategy of that group, right? I mean, it's not, you want, if I'm going to give myself a plug, you want the folks who are ready to have the dialogue comparable to what Joe was talking about and really look at things more dynamically with the cost of capital and size of balance sheet that a utility would have, and that's the type of that's where C2 falls into the market ultimately. But you want to be able to, from an asset ownership standpoint, the market is no longer really made up of these 20-year investment grade PPAs. So it is going to be VPPAs, other financial products, community solar, remote net metering programs, RECs, all these types of products. So it's not, the thing that I would be conscientious of is making sure that you have somebody who really wants to dig in to the real risk analysis, not just, okay, well, this is investment grade or not.
I mean, it sounds like what I'm hearing right now is that there's execution risk, right, on those M&A transactions. And so to look behind the curtain a little bit, and it's not always the simple answer. And I think also, one of the themes I was getting at, this all kind of assumes a real efficient market on all sides, right? So that everybody agrees on the numbers. But I'm curious if you guys think that there's any big differences in merchant assumptions on curves, et cetera, that could drive somebody either away from or to the M&A world right now. Just kind of going back to that, it's been a seller's market for a while. It's been very efficient for a while. So this conversation made a lot of sense. Any sense that I know, Peter, you said no sense yet, but it could be. In this particular context, do you think that this conversation changes at all in 6 months?
I think the investment environment is changing and people are taking less risk naturally, just given the uncertainty in the market. So will investors or IPPs start taking more conservative assumptions on merchant curves? Yeah, it's a fair statement that is likely. I mean, we all know this was a seller's market, and a lot of the purchase price was driven by assumptions post contract. So I think that will still most likely continue to be true. But whether certain investors take a more conservative view will be told in the future. I don't know the answer to that right now. I don't think any of us do.
I also think that this is, for the folks who are asking about storage, the merchant curve thing has been an issue for a long time, right? I mean, that's not a COVID situation one way or another, and ultimately tax equity doesn't really have that much exposure to it. Debt lenders, except for in very specific circumstances, are not really advancing against it. So it's really just a sponsor question, and subsequently an M&A one, and that's been a question that extends long beyond COVID. What I do think is actually very interesting in terms of how the market will change will have to do with frequency regulation, having to deal with storage, right? Because to the extent that the whole work from home paradigm is here to stay, which I believe is here to stay in some form or another, what is that ultimately going to be doing to demand curve and demand usage, and how is that going to play into investments that you were thinking about making in California relative to the duck curve, and how is that? What is going to happen there, right? And so this is something I think it's less about merchant revenue specific to COVID, because we could have this exact same conversation a year from now and 2 years ago on the merchant revenue side. But I think what is actually going to be very, very fascinating is, and we're spending a lot of time thinking about, is how in a world where people are going to be setting up, where the majority of the workforce is going to be setting up a home office, potentially 5 days a week, 3 days a week, how does that change the dynamics of the grid, and how fluid can be utilized, and how frequency regulation can be utilized, and that I think is, at least from what I'm seeing, from a macro market perspective, that I think will be when we look back at what COVID did to the energy markets 5 years from now. This will be the trigger point for a material change in those market dynamics and those market assumptions.
Great insight. So we only have a couple minutes here. Please throw out any final questions you guys may have. I think there was one question I've kind of been ignoring for a little bit here. It's about outlooks on the Latin American market. And I think a lot of our speakers here today are pretty focused on the US markets, but I don't want to completely just assume that away. So are there any insights or expectations, predictions, or interest in the Latin American market from you guys?
Yeah, I mean, again, we focus mainly on the U.S. I think what's the energy auctions in Chile, I think are continue to be interesting to watch, and I think you'll actually end up exactly what I was saying about what's going on with storage. I think it'll be very interesting to see how market use profiles change over the next couple of years in response to it.
Yeah, I agree. Whether it be Chile, whether it be Brazil, whether it be more Central America, the opportunity is there, and that's kind of a different discussion. We're not actively involved in that market. I have been in the past, but as far as I know, it's not been materially impacted based on the current conditions.
And we're focused.
I know Seminole, you guys are in Florida, pretty close there. Any interest?
It's something that we've, I'd be lying if I said I didn't keep my eye on things outside of the country. But we manage pension fund, public pension fund money, and one of the restrictions we have is that we keep that capital in the 50 U.S. and territory. So we're sort of restricted with our primary source of capital at the moment.
It is a shame that the Mexican government, actually, one of the other things that the Mexican government basically canceling renewables, or renewable approval for the time being under the guise of COVID, that is, I think, they're the only government in the world that is looking to do that, other than the United States. Trying to deal around with that stuff.
Well, it sounds like everybody here really has their hands full in the U.S., which is a good thing. So thank you guys all today, and Joe, I'll pass it back to you.
Thanks very much, gentlemen, and thank you very much for joining us this afternoon, for sharing your insight and experience of the market. I'd be slightly remiss if I didn't mention that we are actually running a Latin American storage seminar in June. So the link is there in the chat box if it's a market you're looking at. So yeah, a big thank you to our speakers for joining us this afternoon. And a thank you to you guys in the audience and girls as well for taking part. This session will be available on replay. So if you logged in halfway through, you'll be able to see the full session shortly. So thank you very much all, and that will draw our webinar to a close. Take care, everyone.